welcome to Sectors Up Close. I'm Elena Casas. Today, our focus is on US consumer staples, and my guest is Indrani Day, Head of Global Investment Research at the London Stock Exchange Group. Consumer staples have come into their own in recent months, as inflation running at its highest level in 40 years and worries about aggressive Fed tightening lead investors to get defensive. Staple companies aren't immune to the effects of inflation themselves, though, as the war in Ukraine has sent global prices for basics like wheat, fertilizers and sunflower oil soaring, and American consumers are starting to see those price rises bite into their weekly shop. The sector has outpaced almost all others this year, though. This is the Russell 1000 Consumer Staples Index. As you can see, it's almost flat year to date. Compare that to the wider Russell 1000, which is down almost 14%. The top constituents in this space include Procter & Gamble, Coca-Cola, PepsiCo, CVS Health, Cadbury and Oreos owner Mondelez International, and Colgate-Palmolive. So, why are these companies outperforming the market? Let's ask Indrani Day, Head of Global Investment Research at the London Stock Exchange Group's Indexes and Benchmarks division. Indrani, hi. Why are consumer staples outperforming the rest of the market?
Thanks, Elena. Thanks for having me on this show. Very succinctly, what's happening, we have to see what's happening in the real economy and the linkages to the financial markets. This is a mid to late cycle economy, inflation picking up, Fed tightening. In this environment, it becomes a risk off environment. There's a lot of dispersion among the sectors, but people want to be defensive in this sector, and consumer staple inherently, because it's food, beverages, the kind of products where the demand is much more inelastic. So they are much more protected in this kind of a recessionary environment and a risk-off environment. This is inherently a sector with lower volatility because of these characteristics. And that's why we see that it has been outperforming the overall index, not just year to date, trailing 3 months and the last 12 months. It's the essential characteristics of this sector that make it well positioned in the current macroeconomic and financial cycle.
You say that it's a sector where a lot of consumer demand is fixed, but what American consumers are saying is that they're feeling more and more short of money as prices rise across the board, including for staple foods. So are we going to see inflation also start to bite into margins here?
So that's an excellent question, and we have to put it in the perspective of two things. Financial markets inherently tend to be a little forward-looking. So some amount of, the impact of inflation on margins, it could already be baked into the prices and the returns that we have seen so far. Second point is, while inflation is very high, there are a lot of signs that inflation could be at peak or just around the peak. So maybe the worst is behind us in terms of what we are expecting for inflation, and things get a little better from us. And thirdly, many of the companies in the consumer staples, they are names like Procter and Gamble, Coca-Cola, names that have been in the business for very long, maybe 100 years. They have gone through so many cycles. They know how to operate well in all kinds of environment. They are just better positioned.
If inflation expectations are peaking, though, are we coming towards the end of this very risk-averse time for investors? And in the longer term, of course, consumer staples have historically lagged behind the rest of the market. They are companies that have very tight margins. So will they start to look less attractive?
So, the real economy and the financial markets have a little league lag time. And so one has to price it in that perspective. But what I do want to point out is the extreme defensive nature of this sector. If you look at its volatility, it's much lower than the index. If the index has about 16% volatility, this particular staples industry is just about 13%. Its beta to the market, it's 0.6. So when you are going through a period when people are risk averse or the markets is potentially in a drawdown mode, these are the sectors that people find more attractive.
Very briefly then, how should investors be approaching the space at the moment?
See, I think investors, given market expectations are that probably we will continue to remain in volatile financial markets, I think one needs to consider the volatility is the primary characteristics that one should be looking at. So in that sense, consumer staples is something that holds up beautifully. And another thing I did want to point out, the dollar has been a major impact to US equities. Now, in general, overall, US equities, large cap, have an international exposure of about 40%, and that's been a headwind for US equities. The consumer staples has a slightly higher international exposure, but given that the dollar is so strong, and if it weakens a little bit, and we are seeing a little bit of that, then staples get some benefit from there too.
Thanks so much for joining us, Indrani Day, Head of Global Investment Research at the London Stock Exchange Group's Indexes and Benchmarks Group. Well, before I go, here are some other stories we've been following in this space. Inflation may be easing in some parts of the consumer goods sector as discount chains like Target and Walmart cut prices to clear overstocked warehouses, while food inflation is worsening. Both retail giants say shipping costs and port backlogs for other goods are easing. Both sent shockwaves through the retail industry this month, with steep drops in quarterly profit, saying they would have to offer steep discounts to bargain-hunting shoppers. Meanwhile, in Europe, the owner of a number of discount store chains, including Poundland in the UK, has said inflationary pressure is leading shoppers to cut back, even on essential items. Pepco Group says it's invested $37.5 million to try and keep a lid on prices in core markets, including the UK and Eastern Europe. And finally, that most potent symbol of US consumerism, the Golden Arches, has come down in Russia as the fast food restaurant's new owner, Alexander Govor, is poised to reopen the 850 former McDonald's branches he took over last month. McDonald's closed all its Russian branches in March in response to the war in Ukraine, but while the logo will change, he promises the menu will stick to burgers and fries. And that's your roundup of the consumer staples sector. I'm Elena Casas, and this is Reuters.